Milton Berg, Chief Executive Officer and Director of Research at MB Advisors. It is so great to welcome you on the show. Thank you so much for joining me, Milton.
It's nice meeting you, Julia.
Well, I'm really excited to have you on the show, and I was kind of hoping maybe we could start, Milton, with a bit about your background. I want to hear, how you got into the business and also how your process has evolved over the years. And I also understand you've worked with some legendary names in the business as well.
Yes, well, my background in the business, I got into business back in 1978. I had a background really in Talmudic studies. I felt that the stock market was a challenge. I originally got into the market as a basic Raymond Dodd fundamentalist, doing strictly fundamental analysis. I found I'm competing with all the other fundamentalists, didn't give me much of an edge. And then somehow, early in my career, I discovered there's something called market analysis, technical analysis, which I really took a strong liking to. I spent the last 30, 40 years developing my own technical analysis process, my own market analysis process. I did work with some of the greats. I've learned from everybody in this business I've been in touch with, some of the greats and some of the not so greats. I learned from people's mistakes. I've learned from people's successes. So my vast experience really has taught me a lot. And I try to use it now in this new company. We started the company about 12 years ago. Basically, it's an institutional research firm. We have a very limited number of clients. We have about 300 clients, mostly institutionals or family offices. And our research is really very, very unique and different than the type of research that's generally offered on Wall Street.
Yeah. And when you bring up like technical analysis here, right, you just pointed out that yours is very different from what is typically offered on Wall Street. I don't want you to have to give away everything, but could you kind of give us a peek into side?
Basically, if something is obvious and everyone can see it on a chart, even if it works for a while, eventually it's not going to work. Like moving average crosses, seeing golden ratios, breakouts, and so on and so forth. If it's obvious on a chart, everyone can see it. It's really highly unlikely that it's going to work over the long term. What we look at is the underlying indicators. We've created over 30,000 market indicators. They don't all signal at all times, but we're looking for rarity of indicators. When they do signal, usually they're telling you something that's important. Most of the indicators are truly data-based. Some indicators are chart-based. Some indicators are psychological indicators. But I'll give you some idea during this interview. Hopefully, you get some idea of what I do. What I'd like to start, though, is speak about equities in general. There's an assumption that stocks do great over the long term. It's a very, very false assumption because it's not stocks that do well, it's capitalism that does well over the long term. As companies turn socialist and as companies get big government, the stock markets no longer do well. Prime example is Japan. The Japan stock market, Japan was a great country in the 1980s. The stock market peaked in 1989. In US dollar terms, Japan is down 25% since 1989. What does that tell you about stocks for the long term? Another example is Italy. Italy is peaked in 2007 in US dollar terms. It's down 51%. In their own currency, it peaked in the year 2000, down 45%. So what does it tell you about stocks for the long term? Another example is even Hong Kong. Hong Kong peaked in 2018. It's down 37%. Belgium peaked in Greece peaked in 1999. In their own local currency, it's down 82%. So I think the point we have to make when we talk about the stock market is a great wealth builder, but it's only a wealth builder because of the background of a capitalist system. The more you get away from the capitalist system, the more likely that the stock market won't do as well in the future as it has done in the past. And that's a very, very important note that I like to make to start this interview.
That is a really important note. I want to hear just a little bit more. You just made this case because you're right, there is kind of this assumption stocks do better for the long term, but you're saying the performance, it aligns with I guess the values of a capitalist system.
A free market capitalist, low taxation, small government system. Exactly. As governments get stronger, as people get complacent and ask for the government to do more and more for them, as governments increase taxation, it's less likely that the long-term stock market will do as well as it's done in the past.
It's not as likely. Are you worried about the direction then that we're headed?
Well, yes, I am worried. I've been in this business for a long time. When I started in the business, the United States was a creditor nation. In 1978, they were a creditor nation. Or maybe they just turned to a debtor nation. I don't know the exact date. But now we have trillions and trillions of dollars in debt. Having trillions of dollar debt is not not good for the long-term health of the country. Also, taxation. Capital should not be taxed. If you believe you're a capitalist, if Joe Biden can say we're a capitalist country, or anyone here can say we're a capitalist country, number one, capital is not taxed, because when you tax capital, you discourage capital creation. One of the greatest errors that our country has made, and many countries have made, is taxing capital gains. Capital is used for the growth of the wealth of the country. Capital is not used for the growth of the wealth of the government. And another point of taxing capital gains is there's something called money. There's big debates what money is. It's fiat money, the United States currency. Some people think Bitcoin is money, it's currency, but there's something called natural money, where people will naturally exchange something they own for somebody else owns in a transaction. In the modern era, there's no reason to have government-controlled money. I could take my iPhone and go to a supermarket, and if I want to buy a Hershey bar, I'd be able to give a small fraction of my Apple share to buy the Hershey bar automatically. We have technology to do that. The only reason we can't do that is because capital gains are taxed. If I sell my Apple share, I have to pay tax on it. If you eliminated capital gains, you would eliminate the need for centralized currency, and you'd have a far better capitalist free market system. That's just my view. It's never going to happen. But in my understanding of economics and currency, that's exactly what should happen.
Yeah, no, it's an interesting point too. I want to flesh this out a bit more too, because you also brought up like the indebtedness of our country. Like I actually just pulled up the U.S. national debt clock, well north of 31 trillion. And then it also, I'm sure you've seen this website too. It shows you like how much we bring in tax revenue and whatnot. Do you have thoughts on the debt situation, and do you think that it will ever get resolved?
Well, I think we have enough debt outstanding. No reason for any more debt. No reason to raise the debt ceiling. Basically, the United States will not default if they don't raise the debt ceiling. They will default if they keep paying all of their expenses other than the debt. The first thing the United States should do when they freeze the debt ceiling is pay interest. They have the money to pay interest. Taxation covers interest considerably. And then they should just cut the programs that we can no longer afford. So the United States is not at risk at this time of going bankrupt, of defaulting. If they do default, it's a political decision, because you cut government spending on military, cut government spending wherever you want to cut, and keep paying your interest on your debt. So it's just a false issue of us defaulting. We will not default even if we don't raise the debt ceiling. But I think we have enough debt outstanding. You see, what happens is debt grows. It's like a cancer. Debt used to be 25% of the GDP, and now it's over 100% of GDP. And if you look at off-balance sheet debt and government guarantees, it's nearly 300% of GDP. We can't continue this way. Now, and the only way to solve this problem is to reduce government spending. But both the Republicans and the Democrats have been spending over the years. I don't know if we will ever resolve it, but at this point, we're all talking about potential default if you don't raise the debt ceiling, and that is just a false issue. You don't have to raise the debt ceiling; you will not default. But debt is, yes, most great countries in the world, economies in the world, have collapsed due to the debts outstanding. And we hopefully it could be resolved. I think with political will, it could be resolved. We're a great country. We're still a free country. Our tax receipts increase year after year after year, regardless of whether they have recessions or so on. And I think there's enough tax receipts to cover all the necessary expenses that government should go through. I think we should turn to the stock market, though, because that's really more exciting.
We can definitely talk about the stock market. I'll come back to this because I did take some notes, and it is interesting to me. But I want to talk about kind of like your overall, and usually I start the conversation here, but I want to talk about your overall assessment of the markets right now.
Okay. Before I talk about overall assessment of the market, there's a very important study we did. I did in 2015. People think that what happened in the market in the past will happen in the future, or they look at moving average crosses, and they look at changes in rates of change and various indices and various some types of indicators, and try to project what the market will do in the future. I'm talking about technical analysts. I took the Dow Jones Industrial Average from 1900 to 1950. I took its mean daily return. I took a standard deviation of its daily return. I took its skew and its kurtosis, and we calculated what should the Dow do from 1950 to 2015 based on the statistics from 1900 to 1950. And we found in 10,000 observations, only about 15 observations, random observations, outperformed the actual Dow. So the actual Dow actually did better than 10,000 random observations using statistics going back from 1900 to 1950. I don't know if I make myself clear, but the point is, when my statistician did this work for me, he basically fell out of his chair. He couldn't believe that the current Dow has no resemblance to the previous Dow. So the point I like to make is there are technical indicators we use, as market indicators we use. We always keep in mind that things change. What happened in the past will not necessarily happen in the future. I would like to point out, though, we redid the study using the inflation-adjusted Dow. And in the inflation-adjusted Dow, the study actually came out pretty well. The historical Dow did match the actual Dow, the current Dow, which tells you that the creation of the Federal Reserve in 1913 and the elimination of the gold standard in 1970 changed the nature of our economy and changed the nature of how the stock market works. And anytime what we try to do when we analyze the stock market historically is adjust for inflation rather than just look at the data itself. We look at data just for inflation. And that's one of the tricks we use to give us better types of indicators. Current market, we were very, very bullish in June. We called the market bottom on June 16th. And believe it or not, we were correct. Now, that's kind of a strange thing to say. How can you say you're correct? The market sort of collapsed from June to October. But in reality, the market did not collapse from June to October. In reality, the Russell 2000 bottomed on June 16th and never made a lower low. Even the S&P 500, which made a lower low in October, that low was only 2.45% below the low in June. So which is basically testing area. You get 2.45% below previous low. That's not a collapse. That's just a test of a previous low. So the reality is, if you remember June is everyone was worried about the Federal Reserve raising rates, going to raise rates by 0.75%, but she actually did on June 15th. The market bottomed the following day. There was a question about the war in the Ukraine, and we saw a lot of signs of panic in markets, and underlying panic in markets. So gaps to the downside, we saw spikes in put-call ratios, we saw spikes in downside volume, which told us that the June 16th low is a significant low, and we're sticking to that. The June 16th low is a significant low. In fact, there's a remarkable index. It's a ETF called the ITB, U.S. Home Construction ETF. Now, home construction stocks should be most affected by interest rates. You'd think so. So with interest rates going up, mortgage rates going up from 5.9% in June to 6.8% currently, it actually got above 7%. You think that home construction stocks should be the worst industry. The reality is that home construction stocks from the June low to the peak on February 2nd of this year gained 53.89%, in spite of the fact that supposedly the Federal Reserve was tightening and supposedly interest rates were rising. Well, they were rising. But the fact that the Federal Reserve raises rates doesn't mean they're tightening. The fact that the Federal raises rates means they're coming from an extremely loose liquid monetary condition and turning towards a tightening. But you really can't know when the situation is tight, when financial conditions are tight. I believe that financial conditions were not yet tight, although the Fed was raising rates. I think the 10 or 12 years of quantitative easing and zero interest rates injected much liquidity in the system. I think it had not been drained by June 16th. I think despite the fact that the Fed was raising rates, it had not been drained. That's why we saw this remarkable bull run in, for example, home construction stocks. That's why we saw the Russell bottom on June 16th. That's why the worst the S&P could do after June 16th, despite the fact that long-term rates increased dramatically and short-term rates increased dramatically, the worst it could do is decline 2.45% below its June low, is because there's still excess liquidity in the system. So therefore, we said the bull market began in June, and there was a test in October. We had many, many buy indicators that we got off the October lows. And we were very, very, very bullish. We were projecting a S&P 500 4650 by November of this year, basically saying if the final low in the S&P was October 12th, typical bull market gains 30% within the first 12 months. So 30% above that was about 4650. That's why I had a simple projection of 4650. So Julia, I can give you some ideas of the kind of technical indicators we saw off the October low. I'll give you maybe 2 or 3 if that would be interesting. But exactly what we saw then and how things have changed since then. Yeah. For example, the S&P bottomed on September 30th, and it rallied for a number of days, sharp rally, and made a lower low on October 12th, 0.24% below the September 30th low. But on October 3rd, it was an up day. You saw tremendous volume in the stocks that declined for the day. On balance, the S&P was up on the day on October 3rd, but there was tremendous volume in the stocks that were down for the day. Actually, there was panic volume as measured by a trend above 4. Now, we looked at any time in history, going back to, we have the data going back to 1970, anytime trend was above 4. Trend was basically, to just say, have your views, what that means is, roughly means it's 4 times as many stocks of volume on the downside that you'd expect relative to the ratio of up stocks to down stocks. Anyway, it's a sign of panic selling into the stocks that are down on the day. Over the past, the median gain over within the next 12 months is 21.84%. It happened 10 times in the past. This is one of the indicators we use. There's only one failure where the market did not continue to bull move. So 9 out of 10 times, this is an indicator of a panic at a low. So that's one of the reasons we turned bullish. Another very simple indicator we use on October 25th, which is about 13 calendar days past the low. The S&P 500 generated a third day in 10 in which the volume in upside stocks were at least 9 times as much as volume in the downside stocks. Now, there's nothing to do with fundamentals, there's nothing to do with earnings. It basically has to do with supply and demand and the willingness of investors to buy stocks as opposed to sell stocks. Anyway, we have third time in 10 days. The median return over the next 12 months, each time this happened, was 22.52%. It's happened 10 times in the past. And there was never a down year. There's never a bear market following this. You always had a gain. So that's the second kind of thing we'll look at. Basic technical types of indicators that we look at. So we really were very, very bullish off the October lows. We were telling our clients to go long. We ourselves went leverage long. We had a nice return from October until early February. And that's our view. Everyone's talking about breath rust. I think you've heard many technologists talk about a breath rust. They got it in January. We got our first breath rust actually we got in October. We got a breath rust on October 28th. We got a second breath rust in January, but our breath rust is a different date. It took place October 28th. And again, that breath rust leads to a gain of 20.16%, a median gain of 20.16% within 12 months. So we had many reasons to be bullish. This is on a technical basis. On a fundamental basis, as we said, the reason we were bullish, now people say, how can you be bullish? There's an inverted yield curve. Well, how can you be bullish? The Fed's raising rates. How can you be bullish? The long-term rates are moving up. How can you be bullish? There'll be a recession in 2023. Well, I tried to ignore the so-called fundamental questions because economists have difficulty predicting recessions. How could a typical investor out there predict there'll be a recession in 2023? Yield curve, there's no really logical reason for a yield curve to cause an inverted yield curve to cause a recession unless the banks have to borrow on the short term and lend on the long term, and there's a difficulty in the spread. But the banks are doing quite well during this so-called inverted yield curve crisis. And there's a precedent for an inverted yield curve not to cause a recession. Now it's from 1965 to 1967. You got a yield curve as inverted as today, and it did not follow by a recession. By the way, that's why analysts, when they give you yield curve analysis, they start in 1970, because when they start in 1960, you'd see that inverted yield don't always lead to recessions. So we just said there's liquidity in the system. The market is telling me it's time to buy. We're long the market, and the inverted yield curve wasn't a problem. I thought we may have had a slowdown already in 2022, not a recession. Slowdown was enough to cause the S&P to decline 25%. It slowed down. We're coming out of the slowdown, obvious from the data we've seen in January and February. So we were long. Now, I would point out that I'm still, based on the indicators we had in October, November, December, and January, I still have to say we're bullish for the year of 2023, and I still maintain my projection of 4650 in the S&P. However, the analysis we do, we call it turning point analysis. In other words, many analysts use 100-day moving averages and 200-day moving averages and long-term patterns. But our edge is not to use long-term patterns at all. We've analyzed all market turning points of 7% or greater going back to 1928 in the S&P 500, and we've identified characteristics that occur at market turning points. So February 2nd, it looks to us, was a market turning point. Many strange things happened in late January and early February that are suggestive of, at a minimum, a strong correction, or possibly even that this great bull market that began in June, you remember plus 50% return in the housing stocks, 20% return off the NASDAQ into the August highs and so on. we believe that it's possible that you get a correction, but there's a slight probability that this bull move that I thought will last for quite a long time maybe ended on February 2nd. So what happened on February 2nd? Number one, we all know of the Hulbert Financial Digest. Hulbert tracks sentiment of newsletters. And on February 2nd, actually it started on January 26th, January 30th, February 1st, and February 2nd, the Hulbert Financial Digest Nasdaq sentiment was at a 6-month high. Now, a 6-month high doesn't tell you much because it's very often at a 6-month high, the market is higher. However, during bear markets, a 6-month high has called the tops of bear market rallies. It called the top in November of 2001. It called the top in November of 2002. It called the top in August of 2008. And it's possibly calling a top right here. So that's a technical reason to suggest that the fact that the newsletter writers have turned so bullish, even though the Nasdaq is no way near where it was in August of this year. The Nasdaq has gained off the October lows, off the December lows, but it has not exceeded its highs of August of this year. Yet newsletter writers are very, very bullish. That's a reason to be negative on the market. That's just an external indicator. External indicator means we're not looking at the market itself. We're looking at how people interpret the market, newsletter writers. It's not the greatest indicator, but we have discovered where it's configured currently is where bear market rally tops end. However, we also look at the unweighted NDX. Now, everyone looks at the NDX, the NASDAQ 100. It's an amazing index with amazing, great technologically advanced companies, very high market caps in some of these companies, these 100 companies. But we look at an unweighted NDX index. In other words, each stock in the NDX is equal weighted. So Apple will have the same weighting as a Tesla or as one of the other small companies in the index. And the NASDAQ on February 2nd got within 0.25% of its August high. The NASDAQ unweighted. So while the NDX itself, and let me give you the exact numbers so you'll see the difference. NDX, if you don't mind, I'll get on my screen and give you the number. The NDX itself, at its February 2nd recovery high, was 6.32% below its August 16th high. But the equal weighted NDX was only less than 0.25% below its August 16th high. This constitutes a double top. Now, a double top itself, I say, if something is so obvious and everyone can see it, usually doesn't work. Now, first of all, not too many people look at the equal weighted NDX, not everybody sees it. But secondly, besides having a double top, it also gapped up into that day. It was the only gap up day in the NDX, equal weighted NDX, since the December lows. Gaps is a sign of panic buying. So you have panic buying at the February 2nd into a double top, and the market immediately reversed lower. That's a reason to be negative on the NDX. As I said, the U.S. home construction ETF gained nearly 11% in the 3 days into February 2nd. Now, it's kind of strange. When the stocks were cheap in June, you didn't see 3-day returns of nearly 11%. All of a sudden, after the index is up more than 50%, you see a 3-day gain of nearly 11%. After the index is already up more than 50%. So this is not rational buying. This is telling you that either irrational long buying or irrational short covering by those who are caught short, which often takes place at the top. And that index also gapped into their highs. Another reason to say what happens at February 2nd is it gives you signs at the top. Also, 3-day volume into February 2nd, 3-day volume of the S&P 100 index, which is the OEX, was greatest in more than 500 days. And I have to ask yourself, why all of a sudden on February 2nd, after the market is up some 20% or some index is up 50%, why would all of a sudden see 3 days of high volume? Because people who are short, who are underinvested, decided we got to get in now. And this is usually doesn't take place when it's time to buy stocks. It usually takes place when it's time to sell stocks. So besides the equity market, silver broke down in early February. Gold broke down in early February. Gold mining stocks broke down in early February. China broke down in early February. And stocks we're short. We're recommending being short the real estate ETF. That also spiked up into February 2nd and reversed. Where the bonds spiked up and reversed. The Bloomberg Aggregate Bond Index ETF AGG also spiked in February 2nd and reversed. Something happened on February 2nd. Now, you might know what it is. It has to do with the Fed, but I don't care what it is. I just care what the market is telling me. If I start worrying what the Fed is, the reason for it, I'll get as confused as everybody else. I just know something happened on February 2nd that tells me it's a potential. This might be the end of this bear market, of this rally. It might be the end of the move. At the minimum, we'll have a correction, and at the maximum, maybe we get back to the lows or below the lows. So these are the kind of things we look at. We share it with our clients, and the mid cap. There's many other things I could talk about besides the gap stuff. The mid cap had what's called a bull trap reversal. It actually exceeded its August high and immediately reversed below it. So these are the kind of things we look at, and these are the reasons we believe that maybe February 2nd was a long-term top. At least it's a short-term top. We were long, leveraged long into February 2nd. About 3 days or 4 days after that, indicators turned. We got out of our longs, and now we're 100% short for our clients. We're short a basket of ETFs, and we chose baskets based on the fact that these are baskets that spiked into the high and reversed down. So we're short the GDX, we're short a bond ETF, we're short the Qs. We're short silver. We're short the Vanguard REIT ETF. We're short the emerging market ETF as well as the Spider Technology. Basically balanced amongst them, be 100% short. We don't know if we'll be right. We're not right 100% of the time. We're not even right 90% of the time. Probably not even right 80% of the time. But we're disciplined enough to recognize when the market may be at a turning point, and we're willing to pull the trigger. We're willing to get out if we're wrong. But the way I see it is a good bottom in June. No one recognized it. They finally recognized it in February. Recognized in February the market bottomed in June or maybe October. They all panicked to get in. The Fed is still tightening. Maybe by now the liquidity that built up over the last 12 years is starting to be drained. They are doing quantitative tightening. They are raising rates. And maybe the reason the market held up so well until now was because there was liquidity, and maybe now liquidity is draining. But in any event, we don't really care about the fundamental background. We care that the market was telling us that there'll be a rally, and it may be telling us that the rally ended on February 2nd.
Okay, that was incredible. And that's why I love this show, because you can take as long as you want to answer. Just real quick though, I want to make sure I heard you correctly. Was February 2nd, like do you say a short-term top? Did I mishear that?
No, short-term top. Well, currently, I mean, anyone who looks at the chart, and the market knows that the market peaked on February 2nd.
Okay.
That was big. But I'm trying to point out, it's not just that the market made a high and it's pulling back. That high was a technically significant high. 3-day volume in the NDX is greatest in over a year. 3-day volume in the OEX is greatest in 500 days. Spikes to the upside, gaps to the upside, followed by gaps to the downside. These things are not random. You see, many of the indicators that most technical analysts look at, the most retail investors look at, are random events. A crossing of a moving average, a weak day when the news is positive, or a strong day when the news is negative. These are just random events. On a daily basis, the market is random. We're seeking to not random indicators. What was not random was the fact that for example, the housing stocks had its greatest 3-day run off its lows after having up 50%. Secondly, you had highest volume off the low. Secondly, you had gaps to the upside and reversals. These are things that are not random. These are that take place at tops. These things take place at turning points. And again, we specialize in what we call turning point analysis, and we're recognizing February 2nd as a potential turning point. So far, it's working out well now. And I am saying, since the fundamental background is such, where interest rates are still rallying, where Fed is still raising rates, there's still quantitative tightening. Since this is a fundamental background, and since the action in February 2nd, after such a long run, is suggestive of a top, it may be that this will be the final top in this bull market that we had, even though it's not giving the traditional gains you see in a bull market. So you might call it a bear market rally if you'd like to, if we're going to make lower lows. I don't want to label it. I just want to say at this point, February 2nd top looks like an important top. We're now short. We don't know whether we'll get down to new lows. We don't know if we'll make lower lows. We don't know if it'll be simply a 5, 7, 8, 10% correction. We have no idea at this point. But hopefully when the low comes, when the time to buy comes, we'll see indicators telling us it's a time to buy. Now, I'm only giving you half of the story, really. There's more to this, which we'll get in a moment. But that's the answer. Yes, it's possibly a final top of this bull market. Maybe it's the final top of a bear market rally, or maybe it's just a little high before a corrective low takes place. Those are the three options. We don't have to know at this point what the market's going to do. We just have to know that we have the tools to tell us when it's time to buy and when it's time to sell. That's really what we offer our clients. Our projections are based on history, market history, But our indicators, really, we have indicators telling us when to buy and when to sell. They are unique indicators. I call them compact indicators, not indicators that use broad movements in markets. And they're indicators most people don't know about. I mean, our clients know about it. Sometimes I'm very cryptic with my clients as well. I don't like to give away the secret sauce. I don't always tell them exactly what's in the indicator, but at least they know what's involved, whether it's a momentum indicator, whether it's a lack of momentum, whether it's a breadth indicator, whether it's a market reaction to a previous day's trade, whether it's a volume indicator. They know that, but they don't always know the exact configuration of the assets, of the indicators we've created.
Got it. Okay. So it's turning point. You look at as you just outlined there, turning point analysis.
Exactly.
Where do you think we're headed from here? Because I heard earlier we were talking about being I want to make sure I get this right. Like maybe this was 2022. I'm just looking at my notes, but when you said you had a target of
4650.
Yes.
Based on the fact that we believed in October that was a final low in the S&P 500 and the June low was a final low in the Russell, we know that the typical bull market gains 30% within the first 12 months. And I think if you take the lows of October, the low of October was, and the S&P was, let's see, roughly 3577. Like 3577, and you add 30%, you get to 4650. Exactly. That's the magic for our 4650 projection. It's no real magic, but there is some magic to this because we've identified 24 bull moves, not necessarily bull markets. We've identified 24 bull moves, which were identified by our turning point indicators. 24 bull moves since 1970. And we've tracked. Let me try to get this chart right here. I can find it. Here it is. 24 bull moves since 1970. The median gain within 12 months is 33.35%. As of yesterday's close, it was 87 days since the low on October 12th in the S&P 500. Through day 87, the S&P gained 14.36%. In other words, let's assume a bull market began on October 12th, and let's assume it's going to follow through for the year and have a median return of 30% plus. By day 87, it's at 14.36%. Is that typical or not typical? Well, the median gain within 87 at day 87 is 20.54%. We're at 14.36. We're below the median gain, but there have been many bull markets that did not gain as much as 14%. For example, the 2002 bull market was only up 5% by day 87. The 1999 bull market was only up 8% by day 87. The 1984 bull market was only up 11.99% by day 87. 1978 was up 9%. 1962 was only up 6.5%, and 1957 was only up 4.98%. So we are still tracking the action the market would track if we'd be in a bull market. So I'm not dissing the idea that we're in a bull market. I'm just saying February 2nd gave me some amazing statistics to suggest that it's a top. One statistic I forgot to mention was the fact that hedge funds had the second greatest short covering day in history on February 2nd, into February 2nd. Maybe not the exact day, maybe a 2 or 3 day reading, but these are the kind of things that take place at turning points. And since the market has rallied significantly, this turning point is not an upside turning point. If it's going to be a turning point, it's going to be a downside turning point, especially since you had gaps to the upside and gaps to the downside, which, it's very difficult to go through these things on a video blog. I just want to give you some idea of the kind of things we look at, the kinds that I've been looking at, how fascinating market analysis is, how important it is to have indicators that other people aren't looking at, how important it is to be able to change your mind, because we were really pound the table bulls. We were about 175% long into February, and now we're 100% short. That's a dramatic change. It didn't change in one day. We went from leveraged long to just 100% long, then we went to flat, and then we went to 100% short. So it took about 4 days of trading, but that's our recommendation. That's what we trade for ourselves, and that's what we're doing. And hopefully it's working out. And hopefully, if we're wrong, we'll get out quickly. And if we're right, we'll catch the low, whether the low is 5% below where we are now, or the low is 40% below where we are now. We have no idea. Hopefully we'll catch the low.
Yeah. I guess if you had to sum up your I guess you're are you bearish? Are you bullish? Like,
Okay,
how do
this
you
is a
kind of like
story. I'm going to
contextualize?
tell. I'm a contextual. I'm bearish or bullish. Number one, I'm very bearish in the bond market long term.
Mhm.
Long term, I'm very. We had an amazing 30-year bull market in bonds, more than 30 years. The bull market began in 1981 with yields above 15% in the 30-year. It ended in March of 2000 with yields below 1% in the 30-year. That was an amazing bull market in bonds. In fact, people don't realize this. The bull market in bonds was greater than the bull market in stocks. Now, how's that possible? Because bonds are bonds. You don't have to buy a bond and take the coupon. You can buy a zero coupon bond. And Gary Schilling did a study. And we did it. We've duplicated the study. If you bought bonds in 1981 and you bought the 30-year bond and a zero coupon bond, and you rolled it every year. In other words, you bought a new 30. When it was down to 29 years left, you bought another 30-year zero coupon bond. By the time bonds peaked in March of 2000, you were up over 18% per annum, far greater than the S&P over that period. So bonds actually outperform stocks. But I made another point. I made this point, many times. I actually made it also in a public interview. Is I believe one of the reasons we had the great bull market in the S&P 500 from 1982 to 2023, 2020, 21 or 22, is not simply because the United States economy did well. It's not simply because we had a free market. It's not simply because we had great technological advances in the United States, which we did not have worldwide. It's also because you had a major bull market in bonds goosing the stock market. If you're going to have a bull market in bonds, the discount rate for stocks decreases. As the discount rate decreases, the value of a stock increases exponentially. So we believe one of the reasons for the great bull market in stocks was because you had a great bull market in bonds. We no longer think it's possible to have a great bull market in bonds. I mean, you went from 15% to less than 1%. That just can't happen again unless you get back to 15%. So we think that even if bond markets are flat, it won't be goosing stocks. If the bond market declines over the long term, which we think is quite possible if they don't get inflation under control, then it certainly will be a negative for the stock market. So that's one of the backgrounds where I can't say I'm as long-term bullish for the stock market now as someone should have been in 1982 or someone should have been in 1932. 1932 was probably the best time to buy stocks, which was during the Great Depression, 1932. People also say, how can you buy stocks if we're in a recession? The best time to buy stocks is in a recession, contrary to what people normally would assume. You buy stocks after they've already discounted the recession and they're coming back. We believe that the 30% decline in NASDAQ, 25% decline in the S&P discounted a recession or maybe discounted a slowdown. We thought that the great bull market beginning, with typical 30% gain. Maybe we're wrong about that. This February 2nd action tells you maybe I was wrong about that. Now, how could I be wrong? I asked myself. Milton Berg, how could you be wrong? You're telling your clients it's a bull market. You had all this evidence. We had nearly 60 positive indicators from October through January telling you the bull market. Well, why would you think you're wrong? If you're wrong, your whole system is wrong. Your whole methodology is wrong. Well, there's two answers to that question. Number one is we only deal in probabilities. We're never right. We're only probably right. We're never certainly right. We're only probably right. We only deal in probabilities. So if we just hit a bear market rally peak in February, I'll say we were right about the trend until February, but we were wrong about the long-term trend that it's a bull market leading for the next 12 months or so. That's number one. However, I pointed out to my clients in a special report that I wrote in January that there were 7. I actually listed 11, but for this report, I think I only sent you 7. There are 7 indicators that were missing at the latest lows, at the June lows, at the October lows, and at the December lows in NASDAQ. There were 7 major indicators that normally signal at the bottom of a bear market that did not signal. And if you don't mind, I'll tell you what the 7 are. They're very, very simple. Signal number 1 missing. Volume. We look at 90-day volume in the New York Stock Exchange relative to 5-day volume. In other words, we're looking for a turning point. Strong 5-day volume relative to 90-day volume. This took place at bottoms in 1975, 1978, 1982, 1987, 1991, 2002, 2011, and the 2020 bear market lows and early bull market moves. It did not signal in June, did not signal in October, did not signal in December. Number 1 signal, bull market missing signal. Now, if only one signal is missing, it's no big deal, right? But there's another major indicator that signals that bull market bottom that's also missing, and that is you take the 5-day volume of the New York Stock Exchange, but you look at the volume on stocks that are up on the day, on a 5-day period, relative to the total volume, and you should get a ratio of 50%. In other words, it should be 2 to 1. It should be 50% of the volume on a 5-day basis relative to total volume should be on stocks that are up. Now, that took place early in bull markets in 1970, 1982, 2009, 2010, 2011, 2019, 2020. Did not take place in June, did not take place in October, did not take place in December, which something else is missing. The surge in 5-day upside volume in the New York Stock Exchange. Now, to be clear, we had a surge in 1-day upside volume, which is fine, but you need a surge in 5-day upside volume to confirm a bull market low and a bear market low. We did not get that. Missing signal number 3. 5-day rate of change. This is one of my favorite signals for whatever reason. I mean, I don't know why it's favorite. Maybe it's one of my earliest discovered signals, and that is that most bull markets begin with a 5-day surge to the upside. And that doesn't necessarily take place on the first 5 days off the bull market low. It generally takes place within the first 15 days off a low. So, for example, you want the S&P 500 to have a 5-day gain or 5-day rate of change of 7.4%. If that did not happen, there's something wrong with this new bull move. Now, you saw this off the lows. Of course, you saw it in 1929, you saw it in 1932. I'm starting in 1957 when the S&P became a 500 stock index. Prior to that, it was a 90 stock index. So we do most of our analysis beginning in 1970, 1957. Okay, so you saw off the bear market low in 62. So off the bear market low in 1970, 1974, 1982, 1984, 87, 98, 2002, 2008, 2011, 2020. Basically, you see it off every bear market low. Did not see it in June, did not see it in October, did not see it in December. Something's lacking. The most we saw off the June low was 6.68%. That doesn't cut it. 7.4% is the minimum you want to see. I mean, you see 8, 9, 10% gains. That's another reason to believe there's something lacking in this. That's missing signal number 3. They have missing signal number 4. Is basically the number of new highs. There are 505 stocks in the S&P 500. Used to be 500. There's now 505 for whatever reason. I don't know why they did that. There are 505 stocks in the S&P 500, and we look at how many stocks are making 60-day highs. Now we don't look at the absolute number. We look at the 60-day new highs relative to the total issues and number of new lows. We have our own ratio. What the ratio is not important, but we're looking at 60-day new highs relative to the lows and relative to total issues that are not making highs. And the target is 30%. You want 30% of those we're looking at making new highs, 60-day highs. And that took place in the 82 low, 99, 90, 91 low, 2003 low, 2009, 2010, 2020. And it did not take place at the current low. But bull market missing signal number 4. Number 5 is missing. This is very strange because this is an obvious one that most people do look at. Most other technicians do look at. I'm surprised no one talked about this. Most significant bear markets bottom after at least 90% of the stocks in the S&P 500 are trading below the 200-day moving average. At least 90%. We never got that reading. We didn't get it in June. We are close to it, but we didn't get it in June. We didn't get it in October. We got it in 1974. We got it in 1982. We got it in 2002. We got it in 2009. We got it in 2011, 2018, 2020. It hasn't happened. So although I had many signs of oversold in June and in October, we did not get this sign of oversold. This is a very common sign of oversold. This is a kind of oversold that is so common at bear market lows. It's strange that we haven't seen it, if not for the fact that maybe we did not have a final bear market low. Maybe we were still in a bear market, and we saw a bear market rally, and finally on February 2nd, when all the hedge funds and all the retail investors are finally convinced we're in a new bull market, maybe that's where the market turns lower. Missing signal number 6. People look at the 10-day breath rust. That's nice. It's easy. Everyone follows it. I see on Twitter, everyone's talking 10-day breath rust, 10-day. Well, we say, well, if everyone's at a 10-day, there got to be another breath rust we can look at that people don't look at. So we created the 7-day breath rust. And our ratio for 7-day breath rust in the S&P is 2.5 to 1. If 2.5 times as many up stocks as down stocks, in the S&P 5, excuse me, our ratio is 2.76. I got the wrong number. 2.76 to 1. So this signaled at bull markets in 1974, 1982, 1987, 1991, 2003, 2009, 2011. But it didn't signal 2020, honestly, but it didn't signal 2022. Another thing, the 7-day breath rust is lacking. Now, the reason it's important, because so many people have been focusing on the 10-day breath thrust. It might be an indicator no longer going to work. I mean, people who never heard of a breath thrust before on Twitter are all talking about 10-day breath thrust. So, one of the rules of technical analysis, once it's obvious, it's obviously wrong. Once everybody recognizes something is not going to work, it's possible that the 10-day breath thrust has been such a recognized indicator that will no longer work, and you need the 7-day breath thrust to work. We don't know. It's all speculation. And the final one, missing signal number 7, and that's a momentum thrust in NASDAQ. Now, as you know, the NASDAQ and the NDX is a far more volatile index than the S&P 500. To see a 10% gain over a 5-day period is very common in the NASDAQ. It's even common during bear markets. I'll give you an estimate. I don't have the exact number here. But from 2000 to 2003, the great bear market in NASDAQ, you must have seen it at least 60 times. I'm just trying to look at my chart. Let's say it's only 50 times. You saw the 5-day rate of change is above 10%. Now, in the current bull market, in the current bear market and bull market, you only saw it once. You saw it on March 21st. March 21st was the initial bear market rally in NASDAQ. It gained 10.19% into March 21st, but ultimately, the market declined another 27%. You did not see this kind of momentum off the December low in NASDAQ. Now you see it at bear market rallies. You should certainly see it if a new bull market began. That is signal number 7 that is missing. We have many more. So that's why I can tell you, although we had many indicators suggesting a bull market began in October, we have to maintain flexibility. And now that we saw the market action so the kind of market action we had into February, late January to February, with China rallying and collapsing, with gold rallying and collapsing, with real estate rallying and collapsing, with the equal-weighted NDX gapping up to the upside and creating a double top and so on and so forth. Maybe our analysis was wrong, and maybe the great bull market we expected will not take place, and maybe this was just a bear market rally, and maybe February 2nd represents a turning point. We don't know, but that's how we have to be flexible, and that's how we're trading the current market.
Yeah, like you said, be flexible, and also you were talking earlier. I like the point. I was taking some notes when you talk about like investing. These aren't certainties; they're probabilities. And I think that's really good to emphasize. I want to ask you another question because you probably addressed it too, but maybe just to like drill down or understand, why are stocks ignoring the Fed's tightening moves?
Right. Okay. Well, the stocks have been ignoring the Fed's tightening moves from June 16th until February 2nd, meaning, as I pointed out, the most interest-sensitive group is the housing, well, except for bonds themselves. Most interest-sensitive group is housing stocks. Housing stocks gained over 50% from June to February. So they ignored the Federal Reserve raising rates. Why? Because raising rates is not tightening. Raising rates is just getting back to normal. We don't know what the normal interest rate would be unless we had a free market. Unfortunately, since we have central banks all over the world, there's no way to know what the natural interest rate should be. For all we know, with the current inflation rate, the natural short-term interest rate should be 10% or 9%. We don't know because short-term rates are adjusted by the Fed. So maybe when the Fed raises rates to 4.5%, and everyone says, wow, the tightening, maybe they're still loose and just moving towards tightening. So I would say that the fact that the market did so well from June to now tells you that the tightening was not really tightening. It was just trying to turn towards normalcy. And maybe now they are actually tightening. And maybe now the market's finally going to get a bear market. Maybe what we saw currently was just a correction within a long-term bull market. And the real decline begins now. We have some people out there, I don't want to mention names. There are some very long-term permanent bears, very intelligent people who say we'll have at least a 65% decline from the peak in 2022 in January to the bear market low. I mean, there's a lot to go from there. We're talking 65%. They're going to go roughly to, you're going to get down to, let me do that again. Takes you down to 1,600 of the S&P. I mean, I don't want to say it will happen. It could happen. If the Fed tightens and then over tightens, you don't know. We just know we follow what the market's telling us.
Got it. I want to bring up another topic with you. This tends to be pretty popular with this audience. I would love to hear your thoughts on gold, if you have any sort of outlook there, or just your general thoughts on gold.
Well, just as a background, I managed the United States' largest gold equity fund at Oppenheimer in the late 1980s. So I'm very familiar with gold. I discovered there's no magic to gold. Gold is just a great inflation hedge. But there's no mystical magic to gold. But since gold doesn't deteriorate, you can have gold, you can have gold that's 2,000 years old and it won't lose any value due to time. If you built a house in 2,000 years ago, by now, even though inflation should take the price of the house up, it's now probably destroyed and collapsed because time destroys assets. So an asset that's not destroyed by time, by definition, will hold its value over the long term because it hasn't changed. So what gold has is it's an asset that by definition will retain its value during inflation because inflation raises the value of everything in nominal terms. So gold there's no match to gold. If you look historically, basically what gold has done is slightly outperformed inflation over the long term. The way I measure gold, and I'm very careful about this, is I measure based on how much gold does it take not to buy a suit of clothing, because due to productivity, it's much more efficient making a suit of clothing today than it was in the 1800s. And you certainly can't say how much gold it takes to buy an iPhone, because no iPhones existed 200 years ago. But how much gold does it take for manual labor? If you want any type of manual labor, and basically you find that gold has held its value. If you want to hire laborers, the same fraction of an ounce of gold it took to hire a laborer in 1750 will allow you to hire a laborer today. Because that really hasn't changed. So gold basically is no magic to gold. Gold is basically a commodity, but it keeps its value. Everything, if in theory, should keep its value. Diamonds should keep their value, and diamonds also don't deteriorate. So gold's a great inflation hedge, but since gold has some beauty to it, and since gold is a commodity, gold fluctuates. Sometimes it goes up and sometimes it goes down. But many people don't realize this, that the CPI gained 100% from 1980 to 2001. The CPI doubled and gold was cut in half. Gold peaked at 850 in 1980 and bottomed at 250 in 2001. While the CPI doubled, so gold was actually cut in a quarter in real terms. So although gold is a very long-term inflation hedge, you got to buy it when it's cheap relative to inflation and sell it when it's expensive relative to inflation if you want to sell it at all. If you're never going to sell it, you want to keep it for yourself and for your heirs. You want to buy it when it's cheap and just hold on to it because it's going to maintain its value over the long term. It won't go bankrupt. It won't deteriorate. It won't fall apart, and so on and so forth. It won't oxidize, and so on and so forth. So that's what I think about gold. As far as trading gold, though, since gold trades emotionally, because people think there's a mystical magic in gold, since it trades emotionally, we have indicators that were built to track movements in gold. More importantly, we have indicators that are built to track movements in Bitcoin, because Bitcoin is the most imaginary asset there is. Bitcoin has absolutely no intrinsic value. Never in the history of the world has there been anything comparable to Bitcoin, where people pay money for just a fiction. And therefore, Bitcoin trades on psychology and it trades on sentiment. And we've built models that actually track the movement of Bitcoin. And I did send you the chart. I don't want to give much away about how it works, but basically we have I'll give you some example. Well, I don't believe in Bitcoin. I believe in gold. It's a real commodity. Bitcoin is just a fiction, but it does trade. So it means it trades on psychology and it trades on just people willing to throw the money at something that they think will go up in price. And therefore, it's we wouldn't recommend it as a long-term investment. But if someone wants to trade it, we can give some advice on how to trade Bitcoin. We do tell our clients where we think Bitcoin's at a high, where we think it's a low, but we never recommend it as a trade. We never trade it for our own account either.
Specifically, it's interesting. Like, what does Bitcoin signal to you? I know the price has been, well, I guess it's a little bit off today, but like it's been moving up more recently. What does that signal? Like, is it like an uptick in liquidity, or like? Well, I would love to hear more on that. Okay.
Well, Bitcoin was one of the assets that actually turned down. Let me see. At the February 2nd peak, Bitcoin had a peak on February 2nd. Let me do this right. Bitcoin also had a peak on February 2nd, like the equity assets, like other assets did, like gold, equity assets. Quickly declined 11%, and then rallied back up to a high. It looked like it's going to break out. We have we're neutral on Bitcoin at this point for the short term. We have no indicator telling you to buy or sell at the short term, except we thought that Bitcoin will peak along with the other assets, just as the equities peaked, the housing stocks peaked, and gold collapsed, and silver collapsed. We thought Bitcoin will continue its downtrend. Somehow, when it got above that February 2nd high, there was some panic buying, and people saying now it's time to buy. I personally am neutral on Bitcoin at this point. If someone had to take a trade at this time, they had to take a trade at this time, I'd say take a small trade and expect it to go in the direction of the stock market, which should be down. But I have not much more to say at Bitcoin at this time, other than the fact that it did peak on February 2nd. We thought that might be a final peak. I mean, it had gained. I have this chart here. It had gained 60.77%. No, that's not Bitcoin. Hold on a second. It had gained 63.05% from November 22nd when we recommended it until its February 16th high 2 days ago, 63%. But we would have told people to get out on February 2nd, so the gain wouldn't have been that much, but it would have been pretty significant, nearly 55%. But now at this point, though, we don't have any view on Bitcoin other than the fact that we probably peaked. It should have peaked along with the other assets if we're right that the Fed liquidity Fed is beginning to tighten and the markets are starting to react significantly to the Fed tightening.
Yeah.
Bitcoin, I don't understand Bitcoin. No one has ever been able to explain it to me. They give me books to read. The books make absolutely no sense. The only analog to Bitcoin history was some island someplace in the Pacific where people would use these big rocks, big stones with holes in the middle to ledger marriages and dowries and so on. That has nothing to do with Bitcoin at all. That was just a way of saying you owe me money. It was on a ledger. You owe me something, and you have to pay it back. It didn't pay back with the coin. The coin is never used as its value. It's used as a ledger. But people, if it's a ledger, it can have any value. This coin represents this size dowry. Next one represents a different size dowry, and it's just a way of remembering it, the way of securing in your memory exactly what took place. Bitcoin is an asset. It's not an asset. Bitcoin is a fiction with no intrinsic value. It's not a currency, even by fiat. No government has declared it a currency. No government has said you could pay your taxes in Bitcoin. Bitcoin has no actual standard of stable value, and there's no way to assess, independent of its market price, no way to assess what its value is or what its value should be. An ounce of gold, you could assess what its value is or should be based on its uses in jewelry, its uses in technology. Why would companies that use technology, or why would jewelers be willing to pay for gold to make jewelry out of it? So you can assess its value. You can't assess the value to Bitcoin. It has no value. It's a fiction. It makes no sense, and it's probably just a side effect of the liquidity that's been created for the last more than a decade over the world. People have money and they have no place to throw it, no place to put it, and they're going to basically speculating on this asset. You could have done the same thing with paper cups if you wanted to, rather with Bitcoin. You could have set up a ledger with paper cups, have it in a vault someplace, and have everybody bidding up the paper cups, and that would be even better than Bitcoin because at least that has some value. You could use a paper cup, you could take a drink in it. So I'm totally against Bitcoin, but it's a market, it trades, and therefore we're able to tell our clients at times when we think it's prone to gain, when it's prone to decline, despite the fact that there's really no historical precedent. The younger generation that set up Bitcoin don't understand what money is. You see, as I said earlier in this interview, there's something called natural money. If there be no governments, there be no central banks, that doesn't mean there'll be no money. There'll be natural money, whether it's wampum, whether it's seashells, whether it's bicycles, whether it's candles. Historically, all of those things have been used as money. But it's natural money that people agree has some value. They're willing to trade for something else. And of course, gold and silver has been the best natural money. But nowadays, if there be no central banks, there'll be no fiat currencies. There'll be many, many natural money today because now we have your iPhones. You have all my assets can be on my phone. I could take a portion of anything and go to a store and buy it, and its relative values will all be computerized. So Bitcoin is not a natural asset. It's not a natural currency. It's a currency created in people's mind because they don't understand what currencies are. You can't make a currency out of something that has no intrinsic value. You can't make a currency out of something that has no natural value. And people will argue, well, it's a natural value. People are trading it. Well, they're trading it, but they're not using it. Really, Bitcoin is not really being used in day-to-day transactions. So I don't. And who would use it in a daily transaction due to its volatility? And of course, there's another X against Bitcoin. It's the same old story. The governments around the world tax capital gains. If you buy something with a Bitcoin, you have to calculate what you bought the Bitcoin for and what you sold it for and pay a tax on it, which is kind of ridiculous. Capital should not be taxed, but unfortunately it is. That's another reason why Bitcoin can't be a great currency as well.
Yeah.
That's my view. I know it's controversial. That's my view.
Yeah. Well, I want to ask just one more question before I let you go. And it's more just about the analysis you do, the technical analysis you do, the various technical factors you look at. If you had to like step back and pick one, like one indicator you look at that's like the most unique or interesting, what would it be and why?
Oh, wow. Well, obviously there's no answer to that question. I can't give it, but I would say that volume has always been a favorite indicator of mine, not volume, because volume reflects people's propensity to buy and people's propensity to sell, people's willingness to buy and people's willingness to sell. Like, for example, you had the great crash of 1987, a great crash of 1929. The market was down, in 87, down 20% in one day, and 29 down 20% in 2 days. But believe it or not, volume at those lows was at a record, which tells you there are people willing to sell their stocks 20% lower than it was the day before. And not only people willing, there's so many people willing to sell so many stocks that volume was at a record. That's not understandable. It's understandable why to be a record volume, people willing to buy stocks that were worth 20% more the day before. But why are people willing to sell stocks? So volume tells you a lot about psychology. It tells you about market action, and many turning points indicators that we use have some sort of volume associated, whether it's total volume, upside volume, downside volume, lack of volume, and so on and so forth. So I have to say, if someone's going to start getting into this business and wants to look at something that makes sense, don't look at moving average crosses, and don't look at momentum, and don't look at trends, and don't look at uptrends and downtrends. Just start out with volume. Well, that's what we do, because we look at turning points. If you're just trying to catch long-term trends, maybe volume doesn't help you much, but we don't try to catch long-term trends. We try to get into a trend early and get out when the trend ends. And we look at what happens from the bottom to the top as basically random action, unless indicators give us some reason to think it's not random. In other words, the market grew up 30% in the year, but between the 0% to the 30%, the fluctuations are basically random, in our opinion.
Got it. Well, Milton, if you want to let folks know where they can find you, follow you, learn more about your work, or if you have any parting thoughts for the audience, anything that didn't come up that's top of mind for you that you'd like to put out there, please take the next few minutes to do so.
Well, basically, 2 things. First, I'm writing a book finally on the indicators we use. The book will be available late this year, maybe early next year. And if you want to get a little bit of what I do, a lot of the secrets might be disclosed in that book. Secondly, our company is MB Advisors. Most of our clients are either institutions or high net worth individuals or family offices. We can be reached by email at info@miltonberg.com, info@miltonberg.com, which is my name. We also have a website. The website is being revamped and updated. I think they tell me it'll be done in 2 or 3 weeks, and then you can go to the website and be easier to contact us on the website. I appreciate people listening. I think maybe some of the things I suggested may not be so conventional. It's very difficult to put all this research in a 1-hour interview. And on the other hand, though, I try to do the best I can. I hope people appreciate it and enjoyed it. I certainly enjoyed sharing this with you, Julie. Thank you.
Well, Milton Berg, Chief Executive Officer and Director of Research at MB Advisors, we do thank you. Thank you so much for being so generous with your time and your ideas. Really, really appreciate you taking the time. Milton Berg, thank you.
Thank you very much. Appreciate it.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.